Hello everyone, my name's Toby Hollington. I'm the owner and founder of Smart Business Coaching. Today I just want to do a very quick video on the most important figure that you need to know and understand as a business owner. And that's your break even. Now this is even more important than the time I'm recording this video because we've just come to the end of the JobKeeper and stimulus program, which means that there's no more extra money coming into the economy. Now, it doesn't matter if you're a business that was struggling through this period or if you're one of the many businesses that have done very well through this period. We are now going to reach a point where there's no extra money in the economy and things might cool down a little bit. That means you as a business owner need to understand and look at your costs again to make sure that either you can stand up on your own 2 feet without the support from the government, or that if things do reduce down or come to a new normal or new level, that you've got an understanding of what that break even is and you can still make sure that you're in a profit situation. So it's really important you do this. A good metaphor for what break even is if you think about your business as an aeroplane, one of the most important things you need to understand when you're flying a plane is where the ground is and how far off the ground you are. That's what your break-even calculation helps you understand. Helps you understand where the ground is for your business, and then on a daily, weekly, or monthly basis, you can see how far off the ground your business is performing and whether you need to do something to change the business to make sure that the business doesn't crash. Now, obviously, you can be under break-even for a short period of time as a business owner. You can't be under the ground when you're flying a plane, so the metaphor does break down a little bit there. But in a business, if you spend too long under that break-even level, then obviously the business will die in the end. You'll burn your cash and you'll run out of money. So it's really important that you understand where your ground is. That's important all the time in a business, and it's really important right now. Now, I do this a lot with clients, obviously. It's often one of the first things I do when I start working with them. And there's countless times where you do this with a client and they get a realization of changes they need to make in the business or where they need to focus to make sure that the business makes money. It's a really good tool for analyzing really the profit and loss for your business. So you understand your costs, the difference between fixed costs and variable costs, and your sales and how many sales you need to produce in different areas of the business and at what margin. Now, I'm going to keep this short today, so I don't have time to explain all of that. But if you do want some more help with this, then please reach out, and I'm happy to sit down and calculate your break even with you. But just reach out to me and book in a time, and yeah, I'm happy to talk that through with you. But probably what I will do is I'll just show you a bit of an example from a calculator that I use with clients. And this is an example client, not a real client. But one of the things you need to calculate is obviously you need to work out what your fixed costs are of running the business. Now, I did this with a client probably a few months ago now, when things were pretty bad from a COVID point of view. I obviously had to do this with all my clients, and we did it a few times as we went through the crisis, just to make sure that we weren't burning cash or we weren't going to crash during that period. But I remember I had one client come in and this is very common. So I use this as an example, but this is very common in a lot of businesses. So he had a situation where he had some team members on board. He thought he could get through with the team members that were there, and he had enough work to pay for them. When we did the calculations and worked out his break even, it was very obvious from looking at the figures that he didn't. And the fact if he didn't do something, there was a real danger the business was going to fail. Now, as we did this and he realised this, he went white as a sheet. And he was very nervous and very apprehensive. And that's because he knew he had to face something and do something that he didn't want to do. He had to go back and stand some of his team down. And he didn't want to do that, and some people don't. The danger is, though, often there's things we don't want to do in a business and we don't want to face. So we have our biases to try and avoid having to do that. So the danger is if you don't look at the figures, because the figures give you an objective data point that's not surrounded in your biases. So it helps you to make a clear decision that, I'm going to have to do something. And it pushes you to do something that you don't necessarily want to do. You have to go back and have that hard conversation, or do something that's really not your normal forte, normal way of doing things. But I see that time and time again, not just when I calculate break even, but when we analyze numbers, they give you a better data point to make decisions, and they wake business owners up to realize what they need to do. So it's really good way of facing that, and a good way of you making better decisions for your business. Now, that client obviously had to go back, and he had to stand down his team, and he had to reduce his costs. So he identified that his break-even level, his ground, was very close to where he was. So he created a bit of space between his business, the plane, and the ground, so that he could fly through or navigate this period. I've done that metaphor to death now, I think. But you get the point. So here in this example here, so this is a calculator I use. If you want a copy of this, give me a shout. But you're putting some key figures into here. So the key figures I'm putting into here is understanding, okay, what your gross profit percentage is, which is a percentage of your sales left after paying your variable costs. So that's your cost of sales. That's anything that relates directly to your sales. So in this business, they do a sale for $100. They've got $26 left after paying their cost of sales. So in a retail, that's the products. In a service industry, that could be your wages. In construction, could be wages and materials. But anything that varies directly with sales. So we need to understand what your gross profit is. Then obviously we need to know, okay, how many weeks of the year you open, how many days of the week are you trading, and what is your average dollar sale. So on average, how much is each sale, which is basically just your sales divided by your number of transactions. Then we need to say, okay, let's put a target profit in there. So for this business, we've got a target profit of 500,000. So in this business, we've then gone away and calculated what their fixed costs are of running the business. So here, and this includes your rent, your marketing, admin wages or non-direct wages. They're usually your big things that are in there. So we've worked out for this business, they have fixed costs of $201,000 a year to run the business. Now we've also got some other costs here, which is owners and financial costs. So often when you look at a profit and loss account, and you look at the costs in a profit and loss account, it doesn't include wages, not wages, but it doesn't include drawings for owners or owners' wages if they take it via dividend. Depends how you got it set up with your accountant, but sometimes it's via wages and sometimes it's not. You take a drawing and then clear it off with the dividend at the end of the year. If it's drawings, then it's not included in the profit and loss account. But we need to include it in your break-even calculation because we still need to make sure we've got enough income to cover your wage as well. The other big difference is often the finance costs. So if you've got loans you're repaying, in the profit and loss account, the interest will be in there, but the capital amount of your loan repayments won't. It will go straight to your balance sheet. So we need to cover those capital costs as part of the income we're producing from the business. So it's often good to put that in here. So you can see here for this business, they had 2 loans they're paying. So they're paying off $100,000 a year or $105,000 a year. So they've got a total cost of running the business, which they need to get back from their income of $306,925. And then you can see that per week, 25 grand a week, 25 grand a month, 6 grand a week, or $1,180 a day. So before this business has done anything, as soon as they open for the day, they've spent $1 grand. Now this is often the figure that's quite confronting for an owner when they look at it, but you do need to look at it. And when you're calculating this, what you're effectively doing is creating a budget for what you need to spend. This is where you can potentially save some money. So you can look at what you did last year, look at ways, okay, we can reduce that, we don't need that. These are the things you can change. And obviously, once you calculate your break even, if you find out that you're nowhere near your break even from a sales point of view, this is what you need to reduce. You need to work out, okay, we need to cut back our costs, which is obviously what we all did when COVID, or most businesses did when COVID first hit. For those first few weeks, we didn't know what was going to happen. Then things evened out a bit and we started to spend those costs again because we had the income still. But when we thought the income wasn't there, we have to cut back on the costs. So if you're nowhere near break even, often it's the costs you need to look at. And sometimes that's hard to reduce and sometimes not. But that's the first thing you need to understand. So this business costs you £1,000 a day, or 1,200 to round it up. But then we can work out, okay, how many sales do we need to produce to cover that? So if I just scroll down on here, so this is the break even. So the break even for this business per year is 1.1 million. So that's what they need to do per year, or 98,000 a month, or 22 a week, or 4,540 a day. So they then know what that break even is. Another way of looking at that break even is actually how many transactions they need to do, which is just a break even divided by the average dollar sale. So the break even, the way break even works is obviously your sale comes in, but there's only 26% of that left. So if there's only 26% of that left, and we've got $300,000 worth of costs to cover, we've got to divide that by the 23 times 100. That's the sum behind it. Don't worry about it if you don't understand it, but that's the sum behind it. But then if we look at the transactions, we know that this business needs to do 3,503 transactions per year, or 292 per month, or 67 per week, or 13 per day. Now, what this gives the business owner, they understand each day whether they're in a profit situation or not. At the end of the day, and you should definitely have some sort of daily reporting in most businesses, unless it's a larger contract type business, of what your income is. So at the end of the day, or at least at the end of the week, you as a business owner know, okay, did we make profit this week or not? Or are we flying below the break even? And that's a good motivator, so a good yardstick for you to know, and then also a motivator if you need to do something. If it carries on too long, you need to look at your cost base. Now, we add to that a target profit. So this is saying, okay, we want a profit of 500,000. So if we just add the profit to the costs, we've now got 806,000 as your costs, plus profit, which is 3,000 a day. But then we look at that from a break-even point of view. So if we want this business to make $500,000, we need to do 9,209 transactions, or 3.1 million a year. So that's where we need to add. Actually, 500,000 profit at 3.1 million is not bad. You might see that some of your costs go up when you get a bit higher or a bit bigger like that, but that gives you an idea. So, and if you look at the number of transactions, that's basically 35 transactions. So you can see here, anything between 13 and 35, you're in a profit situation. And anything that towards 35 or more towards 35, you're heading towards that $500,000 profit that this business potentially wants to target. But that's useful information that you need to understand as a business, so that you know whether your business is financially viable and whether you're flying at the right height or not, or whether you're in danger of something going wrong. This is something you should always have in your business. It's something you should redo at least once a year in normal times, and probably more when we've got changing economic conditions like we have at the moment. I'll just show you one more thing before wrapping this up. And that's just the graph of this and what that looks like. Here we go. So this is a graph of what it looks like. You can see from this graph, you've got the green area and the yellow area. So this, sorry, I'm a bit colorblind. That might not be green. But anyway, this bottom area is the fixed cost for running your business. You can see, regardless of what the sales are, they remain the same because they're fixed in nature. The bars here represent sales. The other area here above that is your variable costs. So obviously they go up the more sales you get. So you can see here, when we're down here, the sales are below the costs, the fixed costs and the variable costs added together. So that's when we're making a loss. So it doesn't start tipping over until the middle area. And then as we go up, it kind of goes up. So the further sales go up, the further profit situation we're in. That's what you're calculating here. And this is what gives you a good grounding, a good understanding about your numbers. But that's probably enough. I don't want to risk losing any of you guys with too much technical stuff. But it is really important that we work on these figures. They will really help you understand where your business is at. So I'm just trying to get that back. There we go. And whether you're in a good financial position going forward. I would strongly advise you do this now. And like I said, do this every year. If you want any help with this, please book in a time for us to have a chat with me. Either reply to the email you got with this video message, or if you're on my website, book in for a bit of a call, and we can have a chat. Keen to help you out, and I'm also happy to give you a copy of the calculation spreadsheet if you're keen. But hope you find this helpful. Give us a shout if you need anything. Cheers.